Let's just dive right into this explainer. Today, we're putting on our equity research analyst hats and running NatWest Group's latest financials to the ultimate investing gauntlet. We're tuning out the market noise and looking strictly at the cold, hard numbers from their recent filings to uncover the fundamental truths.
So the big question is, does this major financial institution actually earn a spot in a legendary investor's portfolio? To find out, we're going to evaluate NatWest using the absolute gold standard frameworks of Warren Buffett, Benjamin Graham, Philip Fisher, and Peter Lynch. We want to see exactly what kind of asset we're dealing with, using nothing but their actual corporate data.
Here's the roadmap for our analysis. First, Buffett's quality test. Then, Graham's deep value test. After that, we'll look at Fisher and Lynch's growth potential, run some valuation cross-checks, and finally, deliver our verdict.
All right, starting with part 1, Buffett's test. We're looking at quality economics and the moat.
Now, as you know, banks are uniquely complex beasts, right? So we have to translate general investing metrics into industry-specific ones. Instead of traditional return on equity, we're using return on tangible equity, or ROTE. This is our proxy for Buffett's strict 15% ROE minimum. It strips out all the intangible fluff and shows us exactly how efficiently management is compounding shareholder capital.
And honestly, this number brilliantly illustrates NatWest's moat. In the first half of 2026, they posted a massive 19.7% ROTE that comfortably crushes Buffett's baseline for a high-quality, profitable business. I mean, when a bank is generating nearly 20% on its tangible equity, you are looking at a serious capital compounding machine.
Checking out the rest of the Buffett scorecard, NatWest easily sweeps it. Beyond that killer profitability, they're maintaining conservative leverage with a common equity Tier 1 ratio of 13.2%, which is absolutely crucial for bank solvency. Valuation-wise, we're looking at a highly attractive PE ratio under 10. And, maybe most importantly for Buffett, management has laid out a super clear capital allocation strategy, specifically stating they're planning the next round of share buybacks alongside their full-year 2026 results. Total pass for the Oracle of Omaha.
Moving right along to part 2, Graham's test, where we're hunting for a margin of safety and deep value.
To evaluate Benjamin Graham's famously strict asset-based valuation, we have to look at NatWest's tangible net asset value, or TNAV, instead of traditional book value. Think of this as the absolute bedrock of the bank's balance sheet, literally what is left over if you hypothetically stopped operations today and paid off every single liability.
Looking at their 2025 annual filings, NatWest reported a TNAV of 384 pence per share. So here's the rub. With the current stock price hovering around 668 pence, the stock is actually trading at a pretty significant premium to those hard assets.
When we run this through the full Graham scorecard, we get a bit of a mixed bag. NatWest definitely passes his defensive earnings test. They posted a rock-solid 5.5 billion pounds of attributable profit in FY25, and they easily passed the PE test. But with a price-to-tangible book ratio sitting around 1.73 times, it outright fails Graham's incredibly strict 1.5 times deep value threshold. So, if you're a hardcore cigar butt investor looking for a net play, this isn't it. The market is definitely pricing in future growth here, not just liquidation value.
Which perfectly segues into part 3, Fisher and Lynch. Let's talk growth at a reasonable price, or GARP.
Peter Lynch always said, if you can't explain the business model in one sentence, you shouldn't own it. Well, here's the sentence. NatWest generates profit mainly through dominant commercial lending, supported by massive retail deposit margins, with a fast-growing private wealth segment bolted on. And the 2025 numbers back this up perfectly. Over £4 billion in operating profit from commercial and institutional, and over $3 billion from retail. It's a highly diversified, totally transparent banking powerhouse.
This recent timeline is exactly what Philip Fisher looked for. He wanted management teams executing on strategic long-term growth. Just look at this. In May 2025, NatWest finally shed the last of its government ownership. Then they closed the Evelyn Partners acquisition, effectively doubling their assets under management and administration to over £130 billion. And in the first half of 2026, they rolled out a massive 5-year AI tech overhaul in partnership with Accenture and AWS. Check out this quote from CEO Paul Thwaite. This hits all of Fisher's qualitative checkboxes for a management team obsessed with long-term efficiency. They are quietly revolutionizing customer service using AI. In fact, their digital assistant Cora handled over 7 million conversations in the first half of 2026 alone. They aren't just sitting back and collecting interest on deposits. They are actively innovating to drive massive operating leverage.
Now for Peter Lynch's ultimate GARP test, the PEG ratio. In H1 2026, NatWest's earnings per share surged an incredible 23.3% year-over-year, hitting 38.1 pence. Pair that explosive 20+% growth rate with a highly conservative PE ratio of under 10, and you get a PEG ratio strictly less than 1.0. For Lynch, finding a business growing this fast while trading at a single-digit multiple is the holy grail. It is quite literally the textbook definition of GARP.
And Lynch would absolutely eat up this confirming data. First off, recent filings show corporate insiders bought almost 6,800 shares. Management has skin in the game. On the efficiency side, they drove £250 million in gross cost reductions, pushing the cost-to-income ratio down to a super lean 46%. Top it all off with shareholder returns. They bumped the interim dividend up to 12 pence a share, which is a massive 26% year-over-year jump.
All right, let's move to part 4, the valuation cross-checks. It's time to triangulate intrinsic value.
First up, historical earnings multiples. NatWest's diluted EPS has just been on an absolute tear. They jumped from 53.1 pence in 2024 to 67.4 pence in 2025. And based on their H1 2026 print, they're currently on an annualized pace to clear 76 pence. Now, this rapid growth in the denominator artificially depresses the trailing P/E ratio, which strongly suggests to us that the current market valuation is highly conservative and hasn't caught up to the fundamental improvements of the business.
The disparity becomes even more obvious when we cross-check against peer multiples. A typical mature bank usually aims for a 10 to 12% return on equity. NatWest is cranking out 16.16% on an ROE basis, and their net margin is sitting at a very healthy 20.89%. Despite all that, they're trading at just a 9.8 times PE multiple, while their peers are often commanding 12 to 15 times earnings. The math here is pointing to a market that simply hasn't fully priced in the operational turnaround and the upside from that Evelyn Partners acquisition.
Finally, Part 5, the final investment verdict. Let's synthesize all this data. Let's tally up the scorecard from the filings. Number 1, yes, NatWest fails Benjamin Graham's ultra-strict liquidation value test because it trades at a premium to tangible book. But number 2, it effortlessly clears Warren Buffett's economic moat test with that phenomenal 19.7% return on tangible equity. Number 3, it passes Lynch's GARP test with flying colors, a PEG ratio well under 1. And number 4, it clears Fisher's management criteria by actively modernizing, expanding into private wealth, and leveraging AI.
So ultimately, you have to ask yourself, with market-leading returns, massive AI-driven cost reductions, accelerating dividend payouts, and more share buybacks right around the corner, has the broader market completely mispriced this evolving banking giant? With a stock price of 668 pence, are we staring at the exact definition of a great business trading at a remarkably fair price? I'll leave that final call up to you. Thanks for joining me on this explainer, and remember to keep scrutinizing those numbers.